All right, round three. This is the third study of the Wyckoff day trading tape reading course. This is his own material. This isn't done by anyone other than Wyckoff himself. So there's a number of studies that were done by him specifically for day trading, and this is not really talked about much, and it's actually unknown from what I've seen. There's nothing like this on the internet, and folks don't think that Wyckoff is only for swing trading, but I mean, if you take a look here, 2 p.m., noon, 2 p.m., 3 p.m., obviously it's intraday, right? This is intraday trading. Anyway, this stock has come down from 51 at 2 p.m. That's 2 p.m. And it has come down from 51. Okay. And at 2 p.m. June 1st, it stands at 48. So that's right there. That's the open order. Right there. It dips 3/8 below and then jumps 7/8 on one sale of big sale. Right there, jumps. All right, 1200 at 48 and 4/8 or 1/2. So he's talking about that print right there. So it's a big sale, it jumps up. Then some quarter point wiggles between 1/2 and 3/4, a dip to 600. A dip to 600, 48.18. That's 48.18, 600. So 48. Remember, in those days, you had the way it worked was you had 48, 18, 28, 38, 48, 58, 68, 78, and then 49, and then 18, 28, 38, 48, all the way to 50. So they have in eighths. It moves in eighths. It doesn't move in 10-cent increments. It moves in eighths in those days. Okay, and a rally on small lots to 48 and 7/8. So small lots. What do you mean by small lots? These are ones and twos, ones and twos, ones and twos, ones and twos. Already you know there's a problem. Already you know there's a problem. How do you know it's a problem? You don't rally on small volume. You never rally on small volume. Why? Especially when the pullback before it has more volume. For example, if you tally up this, you have 6, 7, 8, 9, 10. The column volume 6, 7, 8, 9, 10, right? If you tally up the rally after that, you have 2, 4, 5, 6, 7, 8, 9. So the volume on the pullback is greater than the volume on the rally. I've seen this so many times create a reversal in the market that even in those days it's the same thing. Whenever you just look at the pullback volume, right, the volume on the pullback, and compare it to the next up wave, if that up wave goes higher and has less volume, there's a problem. Also, during pullbacks, right, during pullbacks, you know, the ABC correction, that ABC pullback correction, if the B leg during the ABC correction, if the B leg has more volume than the C leg, it's going to continue the uptrend. Very likely. So you have a rally, you have a pullback A, and then B, and then C, the ABC correction. Everyone knows ABC pattern. If the B leg has more volume than the C leg going back down, the chances of continuation higher in the direction of the rally is very, very high. All right. Anyway, that's side point, but the idea here is a rally on small lots where it closes. The opening June 2nd, right here. Because, okay, so the point here is that it was a very weak rally. So weak rally. More volume in the pullback, followed by a weak rally up. The opening goes down with 1300 at 47 and 7/8. That's the open right here. And then 900 and a half, that's this. 400, that's right there. 1100, that's an increase, break on the break. 100, 500, and then 400. A rally of 3/8 and a dip to 47. Rally of 3/8. I don't know what he's talking about there. But a dip to 47 makes a 3/8 trading range. Okay, so 3/8 trading range is understood. Why? Because it's 6 boxes. 1, 2, 3, 4, 5, 6. 6/8 is, 6 out of, what's he say? 3/8. I don't know where the 3/8 is, but he's saying it's a 3/8 trading range. So that would be this. 1, 2, 3. Right? So it's like a minor trading range. I'm not sure why exactly he's saying 3/8. I think it's because of 1, 2, 3. So because this rally down is 6/8. 1, 2, 3, 4, 5, 6/8. Then it pulls back 1, 2, 3. So you have this trading range here. That's your trading range. Change the color. It's orange. Alright, so there you got a trading range right there. So that's the 3/8 trading range. We watch to see which way the stock will go out, which way it will break out. The first signal is bullish, 100 at 47.5. So 1, 2, 3, 4, right there. It breaks right there. Next support at 47 3/8. 47 3/8. 1, 2, 3, which is right there. Another gain of 1/8. It's nothing really that, it's still bullish, but nothing special. Why? Because the breakout is only on 1. You don't really see any, well, actually this column volume would be significant. Well, you have 7, 8, 9, 10, 11. That would be significant because the entire column, if you add it up, it's significant. And the 7 breaking out above the 1 is significant. Why? Because that's the largest print. Since the break on the 11, the largest print is the 7. And this 7, these are the largest prints, and it broke out. So basically, it's just a trading range and a break. Okay? Just breakout right there. A quarter point range, so he's just talking about the 1 and the 3. The quarter point range is 2/8 right here. Then a quarter point dip below that to 47 and 1/8. So that would be that. That's the dip. Higher support than the former low. So higher support than this. If it does not go through 47, this indication is bullish. All right, so basically it's a higher low. All right. So higher low is a bullish indication. That's all he's saying. Everyone knows that. Makes a gain of 3/8 after the half point dip. So 500 at 47 1/4, 100 at a half, makes a gain of 3/8 after the half point dip, still bullish, so it basically just goes up. So he's talking about the 500 and the 100 here. When the price recovers to 47.5, we have a forecast of a breaking out of this range and decide to go with it either way. Okay? When the price recovers, so the fact that it could recover, right, this is important. When it says long right here, it's important. price recovers. All right. So it makes a dip and then it breaks out above it. So you had a breakout, you had a pullback making a higher low, and now it's taking out the high and it goes long. When the price recovers to 47.5, we have a forecast of a breaking out of this range and decide to go with it either way. So the idea is it takes out the high of the down wave, the down column. All right, that's bullish. And so the idea here is, okay, let me just take a step back. You have a trending range, you have a breakout, you have a higher low pullback. That pullback is completing now and taking out the high of the pullback. That's where he goes long. Okay? Because he believes that's going to take out the high, so he's going to go long. Or he does go long over here as it makes the higher high. Okay? Right there where it says long. We place order to go long and stop at 47 3/4. 3/4. Or short at 46 3/4. So yeah, if it this is strange because here's the idea. When the price recovers to 47.5, we have a forecast of a breaking out of this range. Why? Because it fully recovers and decide to go with it at either way. So where is it going to go? Is it going to break out to the upside or is it going to break out to the downside? If it breaks out to the downside, he's going to take the breakout. If it breaks out to the upside, he's going to take the breakout. The idea is you have the range, you have the pullback, and he's just going to take the breakout. That's what he's going to do. We place orders to go long or short. Our long stop is executed. This cancels the sell stop. We immediately enter at an order to sell 100 on stop at 1 point down, which is the stop. So, which happens to also be at 46 3/4. This is intended to limit our risk on the wrong trade to 1 point. The breakout on the upside makes 48 3/8. Okay, so he's just buying the breakout. Right here, breakthrough is breakout. All but 1/8 of the recovery is lost, but another rally starts from 47 1/4. There you go. There have been frequent skips of 1/8 to 5/8. Where am I? These coming at the bottom of the recent decline, indicating light pressure. So here you have frequent skips. So the idea here is just a low volume pullback. Why? Because you have zeros. You have zeros. See that? 0, 0, 0, 0, 0. There's no pressure. Low volume pullback. This is bullish from 47 3/4. The next sale is 500 at 47 7/8. What's he talking about? It's 300 here. 47 3/4. 48 and so he's talking about that right there. Okay, then 400, then 100, 400 and 100. Now looking back over the past few swings, and note that the last bottom was made on 100 shares. Okay, that's this, the low volume pullback area. From the previous sale, and the following dip was 400. So you have 100 and you have 400. Observe he's taking a look at the lows. and he's looking at the 1 and the 4. Then after a half-point rally on 100 share lots, there's another dip on 200. All right, so let's start observing that. Someone is evidently trying to mark the stock down in order to bring out fresh selling. This means that they want the stock. Buying is better than selling. I don't get it. Someone is evidently trying to mark this stock down in order to bring out fresh selling. Well, you have 1, you have 4, and 2. In order to bring out fresh selling. This means that they want the stock. Buying is better than selling. All right, I don't really get this point. All I'm saying is that the low over here has only 1. That I know is bullish. 0 is 1, there's no pressure. Here, someone bought here. And here, someone bought here. Okay, so maybe that's the idea. Why? Because the lowest value here and here has the highest amount. Meaning the lowest value in the column is the lowest, the 0, 0, 0, 0, that's the lowest price. Lowest price has the highest volume in this column. The lowest price has the highest volume in this column. This not so much because you have a 2 up here, but the entire column is really weak. Here though, it's very evident. This is a low volume pullback, and the lowest price has the highest volume. It bounces, goes back down. No pressure on the volume of the entire column, and the lowest price has the highest volume. So obviously they're buying the pullback. So now I get it. All right, and dip back to 49. There's a bulge to 49 3/4 right there. And dip back to 49 with 1,300. Okay. Where 1,300 shares are taken. Then the price snaps straight back to 50 1/4. Okay, I think this is the important point because again, you see the lowest value, lowest price in the pullback or in the column has the highest volume. So I think that's the point of the study, but we'll figure it out later. Then it snaps straight back to 50 1/4, then 50 3/8. We raise our stop to 48 3/4. So just raising the stop, and I'll explain how this is done, but basically it's just a shift. If you have a moving average, right? Everybody knows what a moving average is. And you shift it by an ATR down, you'll get this type of behavior. So typically, Keltner channels have this type of, those channels have this type of behavior where you just shift it down by a certain ATR and you'll have this type of behavior, something very similar to this line over here. And you'll also have it on the top. And then in the middle, you have an average. So in the middle, you have an average, and the top and bottom, you have the average that's shifted by a certain ATR that you can specify, and that would mimic this thing that he has here, the stop line, how he moves the stops. Also note that typically when he does put the stop and when he does move it, he takes the low and at least 2 boxes or two boxes, 1, 2, 1. about at least 2 boxes. He never puts the stop under the low. He always puts it at least 2 boxes below the low. And then when he sees it's in a danger point, then he moves it up to the low. Right? All right, then price snaps back to 50 and a quarter. This is then 50 and 3/8. We raise our stop on both lots. Volume enough comes in to bring a reaction to 49 and 5/8. But the stock closes at 50 and a quarter within 1/4 of its top. Increasing indication of strength have led us to carry the trade overnight. Our stop is raised to 49 and 3/8, assuring a profit of whatever the point is, of 1 and 5/8, if the stop is executed at that price. Of course, there is never any assurance of this, especially in a stock like this one, as the chart shows, has numerous skips. If you trade lighter markets, you'll see this also. If you trade markets that are lower volume, thinner markets, they have this, meaning, the 0, 1, a lot of 1s and 2s. One would, they have numerous skips. By skips, you mean the zeros, but it's just if you're dividing the volume by a high amount. For example, if I were in the chart settings, if I was dividing the volume print by 1,000 and you have a thinner market, you would get a 0. So, if I did it by 100, you might get 900. But if I divided the 900 shares by, if I divided by 100, you might get a 9. If I divided by 1,000, you might get a 0. That's what I'm trying to say. So that's what happens. All right. Indicating a market that is not at all closed. The activity of the stock, however, compensates for the additional factor of risk. All right. So this study, it doesn't seem too eventful, but there's some lessons to learn from it. The first lesson is you see a trading range. It breaks out. All right. So you have cause. Very important. Do not touch a market if it doesn't have cause, because the cause is a line of support. And what he's not mentioning, which if you understand what's going on here, you see this? The 5, the 2, the 1, and 1. As the market is going down, this is going to be this or the one above it. So it would be 5, 10, 11, 12, 13, 14. Here would be 1, 6, 2, 7, 12, 13, 14, 15, 16, 17. So this right here would be a POC. He didn't mention, because he didn't mention the summing of the volume, right? He did not mention that, like to sum the volume. But right here, you would have, let me go over here. These two lines are critical. Man, it's too, anyway. That's 16217 and then 55211. What's important when you have a range, when you have this line of support, that's very important, because if you notice from the close and as it's going down, here you will have your POC. All right, that's a high volume POC. This here, these two would be like a bulging, the distributions of volume would be bulging out. All right, now from that POC and trading range area, what else you noticed that he didn't mention was that there's some high volume prints in it. There's some high volume prints in it, and then you have a breakout. So what I'm getting to is once you have your POC and high volume build up here and the high number of shares that are built up, what you have is a rally and a pullback. And now where does the pullback stop? Lo and behold, it stops at this area. It stops at the POC area. Why? Because this is accumulation, that's why. How do I know? Because I've traded this enough to know. And I know, obviously, in today's markets, right? So, all right, these two lines is POC accumulation and all that. So after that, does that, goes up and then it pulls back here. This print 8 is demand coming in. Let's put demand. That right there is demand. When it comes to that level and you have that increase, that's demand. And that demand is buying on that same line of accumulation, reaccumulating on the pullback with a high volume print. That 8 is bigger than 0, 2, 1, 1, 0, 1, 7, 2, 4, 0, 2, 1, 2, 1, 3, 1, 2, and even the 7s, the whole thing. That 8 right there. So what happens is they accumulate, break out, right? Break out. You're going to notice one other thing. Again, he's not mentioning this because these are his notes, right? The length of the column increasing. The length of the column matters. It's bigger than 1, 2, 3 than the prior 3 columns and breaks out with that 7 here serving as a high volume area or high volume print, not an area. The entire line is high volume. And then it has follow through. And it goes sideways and pulls back to this area right here. When it does that, demand comes in and shoots the market higher. After that, even if you come back, right? Even if you come back, which area is likely to hold? The same POC area where you had the 8, it now is still going to hold. They come back and defend or reactive their buy orders, and it goes higher. Boom, 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 boom. This is very important. The other thing he mentioned was the 4s and the 2s. Okay, when the market rallies and pulls back to these levels here, right? This is where you expect, what is it, the test of the breakout, right? So this is the high, this is the low, this is the high. When it comes back to test the breakout, it's going to, you expect buying. And then you have a deeper test that goes right above the high of the low column, which is again where you expect it. This is where you expect it. Up, down, and this is where you get it. That's the test. These areas are test of creek. This right here, this high, is a test of creek. So that's where they're buying. Even here, the rally, the first pullback is right in this area, which is the the higher test of creek, and this is your lower test of creek. This is where they're going to buy. Here you have the breakout on increasing volume, the 5. And you have all of this comes back down here to right there. That's exactly what you expected. And one of the clues is the high volume prints here. There's one here, 7 as well. That's why this 2 held and did that bounce, but whatever. 6, the break on increasing volume, test of that increasing volume, and it goes higher. Also want to mark that. Chances are it taps this area and goes up. So putting all together, first thing is the accumulation area. Better write this down. So I'm going to add my commentary. I've already gone through Wyckoff stuff, but because I know this, because I've seen it enough, I'm going to add my commentary. So you had the accumulation, which is what he's calling the trading range, and you had a breakout, then you had a test of the POC where demand came in to enter markup. All right. After that, you basically had and then retest the POC in the accumulation area and re-enter and continue markup. So these are the real important points. I don't know where to put this. The other one is two, demand has a tendency to come in at POC in accumulation, tests of breakouts, against high volume prints. So you'll see this all the time. This is the POC test. They came in, breakout, test here, lower test here, break about this high, test, and I was going to do that. Okay, so that's all he has. The real thing that you want to really check is this. If you want to know what the most valuable part of this study is, it's this right here. Being able to detect this correctly will give you markup. Being able to detect accumulation and get in on the tests will allow you to get markup. That's the real, really important part of this story. In fact, if you think that this is distribution also right here, because of the break and the cause here, there are lines, I mean, it's not really that heavy, but there are lines here and here. You know, this is why this initial high gets stuffed in this area. You know, so it gets stuffed and pulled back. Why? This is a distribution block. How do you know? You have to see the lines of support and resistance. You have to see, okay, did it make an upthrust? Does it have high volume prints in that area where selling is being established? And then does it have a break? Okay, so then whenever it goes back into those lines of resistance, it's going to have a reaction. Just like when you have accumulation and it breaks out of that trading range and comes back into it, there should be some reaction. If it's accumulation, you have high volume prints, then those buyers can become reactive. This happens all the time. And it's actually a trading strategy. Anyway, so thank you and have a good rest of your day. Bye.